So let's introduce our analyst for this evening. He is the founder of Wealth Watch GA, Julian Morrison. Welcome back, Julian.
Hey Kalila, how are you doing?
I am great. Still repping the Wealth Watch shirt and the brand I see. I know
Always,
you're
man,
working on some
always.
changes.
Sure. We have to take our time.
How the crew tonight? The dogs. I don't hear
Well,
them. They're quiet so
no,
far.
no, well, I don't want them to hear you because they will answer you. So yeah,
Let me not tempt them, huh?
yeah, probably 5 minutes time, they'll be back. So
I
yeah.
mean, hey, room in the yard, it's nighttime. So tonight we are talking about the performance of the S&P 500 because we know here in Jamaica it has been a bear market this year. But things are a little bit different over in the United States, particularly on the S&P 500. So what is it looking like across the waters, Julian?
Okay, so let's set some context before we start talking numbers. So the S&P 500 is the main index that we use to talk about US equities. And like in Jamaica, the US equity market is very responsive to moves in the central bank's policy rate. Now, for the last couple of years, the central bank has either increased its policy rate or held it steady. But because of the fact that inflation has trended down in the US for an extended period of time, for the most of 2024 and some of 2023, the central bank has decided to change its posture and say, we don't need to be as aggressive on inflation, and we can now start to relax our policy a little bit. So we don't need to hold the reins as tightly as we did in 2022 and for 2023. Now, in that vein, the central bank is looking to cut its interest rates from where they are now, the policy rate that is. So what that does is that it releases more funding into the market, sends more funding into the money market, and it eventually spills over into the stock market. Because the theory is that when the central bank has higher policy rates, investors are being paid more for not taking any risk because the banks, central banks, when they issue instruments, they're seen as risk free. So, for example, when the Bank of Jamaica has money market instruments, such as instruments tied to CDs, then those instruments are seen as risk free. So, if I can get a higher return on an asset that doesn't have any risk embedded in it, then I'm not going to go into assets that force me to take risk like equities and corporate bonds, which is a major factor for why the local market has been so soft for so long. Now, back to the US market, it's slightly different because what has driven the performance over the last year and a half has a lot to do with what is happening in the tech sector. And tech has been more and more dominant, not just because of earnings growth or not just because of AI, but because of fundamental change in the US economy overall, i.e., increased digitization, more products and services that rely on the infrastructure of the internet, and many of the largest companies, such as Microsoft, etc. So, there is talk that the US Central Bank, which is the US Federal Reserve, is looking to cut the policy rate. There is a market consensus of four decreases or four cuts for the year. I think that four cuts is aggressive because the US economy is still strong. And what it means is that if the economy is still strong, it means that inflation won't fall below a certain level because growth comes with a certain level of inflation. So if growth is above the medium term average, it means that inflation is likely to be above the medium term average. And the medium term average growth rate for the US, GDP growth rate for the US is 2%. And right now, the next projection for Q3 2024 is actually 2.5%. And that's actually lower than the actual result for Q2, less than Q1, but when we average all three periods, then it's firmly sits above the 2% average. So if growth is stronger than average, then inflation is likely to be higher than average. So even though the bank feels encouraged enough to relax the policy rate, the US is not totally out of the woods as it relates to inflation overall. But it's definitely not where it was at the start of 2023, or at least the first half of 2023, and of course 2022. So in terms of the performance, the S&P 500 index is actually performing significantly higher than most other equity indices, not just the Jamaica Stock Exchange, but even the Financial Times Select Index in the UK and the indices in Canada and the other indices in Europe. They don't hold a candle to the S&P right now. So year to date, it's up 14.89%, call it 15%.
Nice.
And year over year, it's up 22.5%. So
Nice.
that's a
So
significant move.
what's fueling that though, Julian?
So it has a lot to do with the anticipation around the Fed being more relaxed in its posture, number one. So the market is pricing in further reductions in the policy rates and you're trying to go ahead. So the market consensus is 4 cuts. My estimate is between one and two, based on the fact that the US economy is still strong and that the US economy, well, the central bank is not totally out of the woods as it relates to inflation monitoring. Because even though inflation has what is called a 200, so even though it's in a 2% range, which is the Fed's target to be 2%, um, it's likely to sit above 2% for the rest of the year. And if it is that inflation is going to be above or likely to be above that 2% target, then we can't believe realistically that there are going to be 4 cuts because lower interest rates produce inflation. Why would you cut 4 times when inflation still has not reached the target level? It's approaching the target level, but it's still not there as yet. So it's a balancing act. I do agree with the thesis that there's going to be a cut, but that's not for more than likely one or two. But that's enough to get the market going as it relates to sentiment and get investors to start looking at sectors, not just carrying the major tech stocks, but sectors such as the banks, the large financial entities, the Goldman Sachs, the Bank of America, the Wells Fargo, etc. These stocks that are very sensitive to what happens to interest rates, investors will feel more confident to go into them because lower interest rates benefit banks, believe it or not. Um, there are persons who believe that higher interest rates will allow banks higher spreads, right? They can charge more on loans. But the flip side is that banks also hold a lot of securities. And if these securities are falling in value, then the banks will record what is called an impairment, and that will reduce the profitability of many of these banks, which is what has happened to many of the financial sector players in Jamaica. So,
Mm.
lower interest rates benefit banks on balance. So, you find that the US market won't just be led by upside in one sector, but we'll start to see more sectors starting to perform better. So financial services is one, consumer discretionary is another, and consumer discretionary is exactly what it sounds like. It's what we spend with our discretionary spending. It's what we buy with our discretionary spending. So the Nikes of the world, um, and also the airline stocks, etc., travel, leisure, those kind of stocks. Um, there are others that have continued to do well. So healthcare has done well. There's also consumer staples that has done well. So consumer staples is the opposite of consumer discretionary. These are things that we buy, not necessarily with our discretionary income, but we buy more habitually because they're more in line with our needs. So Colgate, Procter and Gamble, um, Campbell soup, even some things that we wouldn't consider as staples actually fit into the staples category because even when individuals have a slight decrease in their income, they don't buy less of it.
Like
Um,
what?
Soda,
Mm.
Pepsi falls under consumer staples,
I
and so
mean,
does
soda
Coca-Cola.
is cheaper than juice now. I remember when I was growing
Yeah,
up,
that's
soda
crazy,
used
man.
to be more expensive than juice.
Yeah,
I don't know
yeah.
if it was the same here in Jamaica, but in Belize, when I was growing up, soda was a luxury and juice was cheap because everybody have fruits in them yard. You make your own juice or you buy fruit juices around the neighborhood. And soda was the luxury. We used to get soda at Christmas time. And now soda
Well,
is cheaper than, the healthier options. You
well,
have to pay a premium to buy water with your meal.
yeah, that's crazy. That's crazy. Well, what is special about that is that many of the large beverage manufacturers have a relationship with fast food, fast food restaurants. So what you find is that some of the restaurants only sell Pepsi and Pepsi related products like KFC, and Coca-Cola has a relationship with Burger King and I think Wendy's. So what you find is that they get almost like a commission based on each combo that's sold, and that way they're able to sell more volume. It's not that the water brand is not necessarily tied to the same brand because all those brands have their own water products, so they do still benefit. But I think it has a lot to do with how they scale and the commission structure that they might have. Um, but yeah, I think that fast food is a major area of opportunity. I'm not advocating for fast food in terms of diet, but as an investment is somewhere to look. I think that's it's one of the areas that pay steady dividends. And what you find is that those stocks don't have as much downside as the tech stocks. So if you don't have the stomach for tech stocks and you still want to be able to collect a steady dividend, then fast food is another area that you can look into as a theme for the portfolio.
So we have a couple of comments and questions in the chat for you, Julian. Let me take some. So the first one is a comment coming from Roswell, who says Nvidia is hot topics now. It's in the glory days, just like Microsoft. It's not a bad time for them. Flood the market with chips. Do you agree with that?
Okay, so a little about NVIDIA for persons who might not remember. So NVIDIA is one of the large players as it relates to microchips in the market right now. And as you know, many of our devices, all of them, they need microchips to operate. So whether that's your laptop, whether that's your phone, even other devices that might not be as obvious, they require chips. And that's going to be even more prevalent with the onset of AI and the spread of AI. Now, what NVIDIA does is program the chips and they design the chips, but the production of the chips is outsourced to Taiwan Semiconductors. So they design the chip, send it to TSMC to manufacture, they send it back, and then they basically activate the chip. Um, so that's what Nvidia does. That's how they make money. It's now the top performing stock for the year on the US market. It might be the top. It might be in the top three for the next year or so because it doesn't have a monopoly necessarily, but it has a great competitive advantage. It's very hard for competitors to try to catch up and replace the market position that Nvidia has as it relates to where it sits in the value chain. They've been around for a very long time, believe it or not, over 20 years, and they are very dominant where they sit in the market, so much so that they are currently being considered for antitrust accusations in the US, meaning that they have uncompetitive practices, meaning that they're too dominant in their industry. And it's under the ambit of unfair competition as it relates to the US law. That's up for further development because we don't know what will come of that. But what we know is that their market leadership is very hard to replicate. And actually, I recommended it back in the day. Prove
Yeah,
not
about 2, 3 years ago, right here on Taking Stock. I never forget it.
I didn't even remember that I mentioned it on Taking Stock. I remember there was a debate at work over it because I was talking about it and people were saying, boy, what is NVIDIA? Clients don't know that. I say, oh, just chill. Don't worry that the clients don't know. We will guide them and tell them what it is, and this company is going to be one of the knockout performers. Sometimes you have to bet on a dark
Yeah,
horse.
it was like, I think it was around 2021. You did a whole presentation on it here, Julia. I can't
I
believe you
didn't
forget
remember
that.
that. Yeah,
Because
I'm sorry.
I specifically remember your presentation on NVIDIA and on
Yeah.
Crocs. And like a genie, like a, like a fortune teller, your predictions manifested a couple of years later with
Oh,
magnificent returns. I was like, yeah,
okay.
Julia
Well,
knows.
we'll give thanks for that, you know. Sometimes you have to bet on a dark horse. You can't wait on the market to take a cue. You can't always chase the market. You have to follow the
Exactly.
data. You have to follow the data. You have to do your homework. Um, I think another one that is likely to do well is Texas Instruments. Many persons know Texas Instruments to make calculators, but they also produce chips, and they
Mm.
also play a role in developing weapon systems for the U.S. government. And I'm of the view that we're going to approach armed conflict in the next 3 years based on what's happening in terms of geopolitics. Um,
Are
and
we ever out of armed conflict? Isn't Russia, Ukraine still going on? Like there's always something.
yeah, we are. I'm just thinking that there'll be an escalation because if you think about it, and this is just me guesstimating now. I'm not a geopolitics expert by any stretch of the imagination, but if Trump wins, Trump is likely to be an aggressor based
Mm.
on his personality. He's pro-US. He's likely to break up supply chains in order to have more manufacturing happening onshore to benefit the US economy. Now, that's likely to harm diplomatic relations between the US and other trading partners such as China. And there's also the consideration of if Harris wins, what a Harris victory is likely to do is embolden the enemies of the US because those enemies respond to fear. Many of them fear Trump because they know he is a war dog based on his personality. He's very similar to Bush and those kind of presidents. But Harris is likely to take a similar line to Biden, who will more likely look at negotiation or trying to hit middle ground and not take as an aggressive stance as it relates to armed conflict or direct armed conflict. So Trump is more of a hawk, she's more of a dove. But based on where we are now and the tensions that are at hand, I believe that the US needs a hawk, not a dove. But if she wins and she executes dovish policy, what that will do is give Russia, China, et al. More confidence to be more of an agitative force towards the US. And that will force the US
Mm.
to have to buy more weapons. So in case A, more weapons. Case B, more weapons. So you need to look at weapon manufacturers and programmers of weapons, any entity that's a part of the weapon ecosystem. So Texas Instruments is a part of that. The market is not talking about Texas Instruments, so it might be cheaper than an NVIDIA for argument's sake.
Very interesting analysis and bringing it up as well right now because the debate is actually going on right now. I don't know how closely you've been following their policies, but what do you make of the candidates' economic policies? Like I know Harris has announced larger tax incentive for small businesses, so up to $50,000 pre-tax for small businesses, and stuff like that. I'm not sure the specifics of Trump's economic policies, but we already know kind of where he stands in general. What do you make of their economic policies?
Well,
You said for
what I've
basically
seen,
what you were saying is that for foreign relations,
right?
Trump is the better pick externally,
I
but
think the US
internally
needs
for the
Trump now.
United States. But internally for the United States, uh, what would be your preference?
Okay, so none of these are my preferences. I'm just trying to everything we do is just about reading signals and trying to adjust the odds. So we're just working with odds and what the likely scenarios are. Right? So we'll have to entertain both outcomes in terms of the odds. So I think that Trump's philosophy is more libertarian in that he believes in more free market policies. So there are two different types of modern economic structures. I will leaving out planned economies. So we're not talking about Cuba or China, right? Even though China is kind of different, but we're not dealing with planned economies. We're dealing with economies that are modern and have free trade. So they're Keynesian economies that essentially have a mix of free trade, but they believe in a certain amount of regulation to come in, and the government should play a role in how resources are allocated, right? So they believe that some industries should be regulated, some prices should be set by the government and not purely by market dynamics. But libertarians are hardcore capitalists. They believe that everything should be strictly dictated by market conditions and that there's little to no need for regulation. So Trump leans a little bit more to libertarian philosophy, and as a result, he is not as ready to implement heavy taxes on corporations as Harris would. So Harris is more, she's leaning more left. So she's more Keynesian, but she's also tilting a little bit towards not necessarily a planned economy, but to have heavier regulation. So she wants to implement taxes on unrealized capital gains, not just regular capital gains or realized capital gains, I should say, but unrealized capital
When
gains. So
I
for
first heard
example,
that, I was like, that is insane. But it's
yeah,
specific. It's unrealized capital gains over $100 million. So that is like the 1% of the 1%.
but we have to also think about pension plans, 401ks, because that's going to affect the average man. So is it really 1% to the 1%? Because if you have a pension plan that is for firemen or policemen or teachers who are everyday people who work hard, and that fund that controls tens or hundreds of billions, and they have a 30% capital gain or 20% capital gain, that's still a significant amount. It would fulfill that criteria that you mentioned. And if that fund has to pay higher taxes on its unrealized capital gains, it means that the pensions or the pension plans of those individuals who work hard every day are going to have less returns because the returns are net of taxes. So it's actually a wealth destructive policy. It's thought to be um, a wealth transfer from high net worth individuals, persons who own the factors of production, to the everyday man, but it's really not when you look at it from a pension standpoint. Because most pension funds in the US, especially the large ones, there are a lot of mega funds that control entire industries in terms of who manages the funds on their behalf. What it will do is that it will set prices back as it relates to their pension payout. So that's not good. Also, what that is likely to do is discourage American entrepreneurs from setting up shop onshore in terms of where they register their enterprises. They'll just register the enterprise in another territory like Ireland, for argument's sake, or Cayman, or Saint Lucia, or Barbados. So that is actually not beneficial in terms of tax revenues for the US. And the US economy, even though it's growing above its average pace now, when you look at longer term projections, that's not likely to hold up. So again, it's a balancing act. So on one hand, Trump is less accommodating to immigrants, but want to increase manufacturing in the US, and he wants to push enterprise, and he wants to have more business friendly tax policy. But on the other hand, Harris is saying, okay, I want to be for the people. Large firms need to pay more in taxes. And I really think it's a matter of the approach, right? So I don't think taxing unrealized capital gains is the way. There might be more benefits that could be offered to these firms to say, look, if you pay 2 percentage points more in taxes, or if you have more of your assets registered in the US, you get another break here, or you get preferential terms as it relates to purchasing land or whatever the case may be. It's really give and take. And again, I'm not a politician, so I'm not really in a position where I can say, hey, I know it all. There are other variables at play. There are things that are not mentioned to the public. There are definitely very real forces behind the scenes. So we have to take everything with a grain of salt. Even outside of the typical promises in an election cycle, we have to factor in the US is likely to go to war in the next 5 years. I know there are a lot of rumors around it, but it's only a matter of time when you look at how Russia and China have been coordinating their activities in the last 3 years. I'm not a conspiracy theorist, but even US military intelligence experts have said the same thing. And I'm really taking their guide. If they have information that we don't have, and they're saying, look, it's only a matter of time, then work with it. Oh, yes, I forgot to
And so the
mention.
play is Texas Instruments.
Yeah, and healthcare is a good area to look at. As I mentioned before, energy is another area to look at because even though there's a lot of talk of green energy shifting to EV, in terms of the infrastructure, it's very difficult to totally move away from carbon-based energy sources. So what we're finding is that the further you have to drill for oil is the more expensive it becomes. And oil is actually a finite resource. And that is why many of the largest oil producers in the world had to look for new sources of oil because the the closer the oil is to the surface, is the cheaper it is to produce. And Guyanese oil would be closer to the surface than oil older in older fields because most of the reserves would have been exhausted. So energy is actually scarcer relative to demand than most of us realize. I'll say that again. Energy, carbon fuel, carbon-based energy is actually scarcer relative to demand than we realize. So a lot of the prices that we've seen, especially this year, is not actually reflective of true supply demand dynamics. A lot of it is because of OPEC's activities. So when OPEC comes in and floods the market with extra barrels, then the price will move. Or if OPEC comes in and announces cuts, then the price will move. But if it wasn't for OPEC coming in with these ad hoc decisions, which are hard to predict, and we were to see a true supply demand dynamic, then oil prices would be much higher. They'll be much closer to $80 or $100 a barrel. And if it is that the US goes to war, which is being argued as something inevitable, well, it's a matter of a cycle. So even if you look at it in terms of cycles, it's likely that it's going to happen again in the near term, at least in the next 5 years. It means that energy demand is likely to spike because it takes a lot of energy to mobilize a war machine. When you're thinking about logistics, thinking about ships, jets, a lot of these weapons that have to be mobilized, it takes a lot of energy. I think it's either the second or third largest line items on our military budget, energy. So energy is definitely a good opportunity to look at, and it's quiet. Not a lot of people understand energy, but kind of stick to the big names, the Exxon Mobils of the world, etc. You don't have to go down a rabbit hole. They pay steady dividends. They're cheaper than many of the other sectors like tech. Um, I think it's even cheaper than healthcare in terms of the PE multiples. So it's a huge overlooked sector. And oil or energy, I should say, as a sector, it has created wealth for many persons. So it's another area to look at.
Well, thanks so much for explaining. I saw Kemoy saying, thanks for explaining this. I want to thank you too. It was a great discussion. I love having discussions like these. Thanks for coming on, Julian. Always
Anytime,
appreciate it.
Kalila. You've been there from the very early days of my career, so anytime.